Let's jump right into this one, folks. Today, we're putting on our investor hats for an explainer on what is honestly a massive operational transition. We're unpacking IREN's pivot. They are shifting from legacy Bitcoin mining right into the booming, high-stakes world of AI cloud services. It's a genuinely fascinating case study in corporate agility, and we're going to break down exactly how they plan to pull it off. So this brings us to the ultimate question driving this whole explainer. Can a legacy Bitcoin miner actually transform into an AI infrastructure giant, right? It's a really bold ambition. Now, over the course of their recent earnings call, IREN's management laid out a highly compelling thesis for this. But, as with literally any major strategic pivot, the devil is always in the details. But hey, before we go any further, I need to make a really quick but absolutely crucial point. This is not financial advice. Seriously, do your own research. We are just here providing an impartial educational analysis of IREN's public financial docs and their earnings call transcripts. Our goal is just to help you thoroughly understand the actual mechanics of this transition. So let's keep that analytical mindset locked in as we look at the data. Okay, here's our roadmap for today. Number 1, from Bitcoin to AI. 2, capacity, customers, and capital. 3, the Microsoft mega deal. And finally, number 4, a risk reality check. All right, let's dive into part 1. From Bitcoin to AI, evaluating the financial turnaround. The stark contrast in their recent 10K filings tells a really compelling story here. So look back at 2023. IREN reported a pretty substantial net loss of roughly $171.8 million. Then, in 2024, they narrowed that down quite a bit to $28.9 million. But 2025? Well, that is where the pivot really shows its teeth. They swing to a positive net income of $86.9 million. This on-paper turnaround is driven largely by their transition toward these much higher-value AI workloads, which basically helped offset the lower operating hash rates over in their legacy mining operations. Moving on to part 2, capacity, customers, and capital, which is management's core framework. During their recent earnings call, co-CEO Dan Roberts was heavily pitching this concept he calls the 3 Cs. First up is capacity. We're talking real assets here: land, low-cost power, data centers. Next is customers, specifically focusing on these long-term bare metal partnerships with the big hyperscalers. And finally, capital. This means relying on highly disciplined financing and keeping that balance sheet strong. And it makes sense, right? These 3 pillars tightly reinforce each other. You absolutely need capacity to attract the best customers. Those customer commitments then dictate your pace of investment, and capital is what actually allows you to execute the physical build-out. Now, when it comes to that first C, capacity, IREN has secured an absolutely massive footprint: 4.5 gigawatts. To put that into perspective for a second, 4.5 gigawatts is enough energy to power over 3 million homes. In a global market that is severely power-constrained right now, that is enormous. This total actually includes their newly acquired site down in Oklahoma, sitting on a massive 2,000 acres. And since time to data center is basically the ultimate bottleneck in the AI industry today, having that much secured grid power, that's a huge competitive moat. Okay, this right here is a massive aha moment for anyone evaluating IREN's potential. Management has projected a targeted $3.4 billion annualized run rate, or ARR, by the end of calendar year 2026. But here is the truly staggering part. Hitting that multi-billion-dollar target requires utilizing only about 10% of their 4.5 gigawatts secured power capacity. The remaining 90%? That's just available runway. It really highlights the inherent growth potential sitting in their portfolio, completely without the immediate need to go scramble for new grid connections. So let's get into part 3, the Microsoft mega deal, and scaling the AI cloud. The financials driving this specific catalyst are just staggering. IREN secured a $9.7 billion AI contract with Microsoft to deploy 140,000 GPUs. But what really stands out as an investor is how they're paying for all that hardware. They've secured $1.9 billion in prepayments directly from Microsoft, alongside a $3.6 billion delayed draw term loan from Goldman Sachs and JP Morgan. And get this, it's at an incredibly attractive interest rate of less than 6%. Combined, this structure covers roughly 95% of the GPU-related capital expenditures. So yeah, they are getting their core hardware financed almost entirely by the customer and highly efficient debt. Of course, to turn those impressive on-paper numbers into actual recognized revenue, IREN has to hit some very strict execution milestones. In 2024, the hyper-focus was on energizing the Sweetwater 1 site. Now, as we move through 2025, we're looking for a progressive revenue ramp as that Microsoft contract actually comes online. By the end of 2026, the ultimate goal is to have all 140,000 GPUs delivered, which unlocks that massive $3.4 billion ARR. And then looking further out to 2028, the massive Oklahoma campus officially begins its ramp schedule. Make no mistake, this is an aggressive, multi-year pipeline that is going to demand flawless execution.
That brings us to part 4, the risk reality check. Let's see what the SEC's 10K actually reveals.
Reading straight from their own filings, they state, our HPC and AI services have and may continue to have significant customer concentration, and we are exposed to counterparty credit risk with respect to our customers. The inherent vulnerability here is pretty clear. They are relying so heavily on a single hyperscaler. If anything sours in that Microsoft relationship, or honestly, if broader market demand just shifts, NVIDIA's highly concentrated revenue stream could face immediate and severe pressure.
And that's not the only hurdle. The filings also bluntly state, supply chain and logistics issues may frustrate or delay our expansion. Think about it. Procuring, delivering, and installing 140,000 high-end GPUs on a rigid timeline. That is a monumental logistical mountain to climb. Any serial hardware defects, or even just delays from vital suppliers like NVIDIA or their construction partners, could severely disrupt their capacity to actually meet those 2026 targets.
So analyzing IREN from an investor's perspective right now requires balancing two extreme weights. On one side, you have incredibly high upside. We're talking a multi-billion-dollar cloud revenue run rate, massive secured power, and locked-in cheap debt. But on the other side, intense high risk. There's extreme customer concentration, the ever-present threat of supply chain delays, and let's not forget, a historical background of operating losses prior to this turnaround. It really is a classic high-stakes infrastructure play. So I'm going to leave you with this final provocative question to evaluate for yourself. With a $3.4 billion revenue target relying on just 10% of their massive secured power footprint, are the potential long-term rewards of IREN's AI pivot actually worth those immediate concentration and execution risks? It is a truly fascinating corporate transition to watch unfold, and one that is undoubtedly going to test management's framework in the coming months and years. Thank you so much for joining me on this explainer, and as always, keep your eyes on the data.